Trade Live. Apple will be back or pull back the curtain this afternoon when it reports its fourth quarter earnings after the closing bell. Analysts are expecting adjusted EPS of $1.73 and revenue of more than $101 billion for the quarter. You can catch extended Apple earnings coverage today on Market on Close with Marley and myself here on the Schwab Network. So let's go inside out on Apple earnings ahead of this report card. Joining us now is Angelo Zino, Senior Equity Analyst at CFRA Research. What are you expecting from Apple later today? Angelo, good morning to you.
Yeah, good morning and thanks for having me. So, I'd say overall, we expect a fairly upbeat earnings call here. Looking for top line growth, let's call it about 7-8%. There's going to be a number of storylines here. Clearly, everybody wants to know how momentum is for the iPhone 17, and guidance is going to be a good indicator of that. I'll say that, based on what we're seeing right now in terms of growth rates for the June quarter, September quarter, this is the best growth pace we've seen from Apple in about 4 years or so. So they've got something, definitely going for themselves. And we think some of these growth rates are going to be sustained at least into 2027, not only through 2026. I think other storylines that you have to keep an eye on clearly are going to be the services business. We want to see that services continues to grow at around a 12 to 13% clip, given what we've just seen from the Google search monopoly case in terms of the remedies. That bodes very well for Apple here in the foreseeable future, even though, and all those remedies won't go into effect until 2027 due to appeals. And then finally, I think China, something you definitely need to keep an eye on. We returned to growth for the first time in about 2 years in the June quarter. We think there's going to be high single-digit growth here from China in the September quarter, and we expect that momentum into the December quarter because of, we think, the strength that you're going to see more so from their base iPhone 17 device.
So it really is an iPhone 17 type story for this quarter as well, as to what it's got going for it. I suppose the big elephant in the room right now is artificial intelligence. So what are you expecting to hear on that front?
Probably not much, and that might not be the most positive thing. But listen, I think you'll hear Apple will provide their typical commentary as far as Apple Intelligence is concerned, how they remain pretty optimistic about the story. I don't think you're going to see any sort of major commentary that we walk away on AI. It's not typically how Apple works on these calls, but nonetheless, we do remain believers on the AI story. We do think they're going to get the Apple Intelligence story right by the developers conference next June. That really is kind of the cutoff date for Apple to get it right. Whether or not they have it, they have something internally ready to roll out on their own, or whether or not they've got to partner up with the likes of Google with Gemini, remains to be seen. But again, I don't think you're going to hear that sort of commentary on this call today.
Okay, really testing the street's patience, no doubt. But at least the iPhone 17 can maybe sort of carry us through, and particularly if we continue to see that bright spot being the Chinese market. I'm just wondering, as far as what we've heard from the other companies and sort of where Apple sits in the grand scheme of things, given what we heard from Meta, Microsoft and Google yesterday, and then the reaction in the market today and some of the, analyst calls off the back of that. So, what are your expectations as to, how markets could react come Apple's earnings?
Yeah, listen, I think what Apple does have going for them is that they are more of an asset-light business model, right? Their capital intensity level is closer to 3-4% relative to the likes of, let's call it a Meta, which next year is probably going to have a capital intensity rate, north of 35% or so based on our assumptions. So when you kind of start looking at some of the hyperscalers, the cloud providers are absolutely seeing some great strength in terms of bookings. And we actually think the higher CapEx plans are actually warranted, and why you're probably seeing a good reaction out of the Alphabets and even Microsoft holding up pretty well here is because of the strong momentum in bookings. Meta's a little bit different because they've got to absorb a lot of those costs. They don't necessarily have a cloud-oriented business, and I think the street is a little bit spooked about that. But again, that being said, Apple should, we think is a little bit more isolated to some of the concerns out there about CapEx spend and what have you. So I think as long as they can, put up a fairly good number, specifically on the hardware side of things, because we're pretty optimistic optimistic about what they're going to post in terms of services. We think the stock should hold up, maybe digest some of these gains, but nonetheless, we remain very optimistic going into 2026. So any pullback, we think, likely gets bought out pretty quickly.
Okay, and I see you've got a price target there of $280 right now, sitting at $269 and change. Angelo Zino, always a pleasure to have you on. Thank you so much for your analysis and insight, Senior Equity Analyst at CFRA Research. Let's trade it now with Tom White, host of Fast Market. An example trade looking bullish for Apple. What's the approach there, Tom? Good morning.
Yeah, moderately bullish here, Sam, on this one, just because the option market's only pricing in about a 3.3% move in the shares either way, about $9. So implied volatility levels, because we've seen this, move to all-time highs, has kind of come in a little bit. So expectations aren't for a massive move either to the downside or upside. So I looked at a strategy that takes advantage of that while also reducing the risk on this bullish position. So I looked at an unbalanced or broken wing call butterfly to the upside. There's really short-term positioning in the October 31st weekly options that expire in just one day. So it's a pure earnings type of trade where I'm going to buy one of the 270 strike calls and then go about that one standard deviation, sell two of the 280 strike calls, and then buy one of the 285 strike calls. So in essence, in this strategy, you're buying a $10 wide bullish call vertical, offsetting some of the cost by selling the $5 wide call vertical, with the same common strike being the 280 level here where you think it's going to go. Now, if you pay roughly a debit of about $2.80 for that, that's going to be your risk. It's probably trading closer to $2.50 right now, so you can get a little cheaper. But if you pay $2.80 debit for it, that's going to take your break even up to $272.80. Over the next 24 hours or so. That's only about 1% above the current share price. So like I said, you don't need a massive move to the upside on this one. And as opposed to buying maybe the 270, 280 call vertical, you're doing this unbalanced call butterfly because it reduces your initial cost on this trade, which is the risk on this one. So you're risking what you pay, so roughly about $280. With the potential, if it settles at or near that 280 line, you can profit over $700 on this type of trade. Now, if the stock continues to move higher and goes even above the 285 level, it's still going to be more than a double in profitability on this type of trade. So it's moderately bullish where you want the stock to go higher, but you don't need it to go higher. There's not a lot of extrinsic option premium. As I mentioned, implied volatility levels have come in due to the fact that the stock has moved higher. But the bar is really high on this one, where maybe a lot of the good news is already priced into the stock, but this takes advantage of a grind higher. And like I said, you only need less than or about 1% move to the upside to get above that break even for profitability.
Yeah, well, as Angelo Zino said, let's see what the numbers tell us as far as the hardware, the services side as well. But he's pretty optimistic going into 2026. Certainly seems to say that this dip, if anything, off the back of these earnings, could be an opportunity to sort of step in. But a great look at Apple there for us. Thank you so much for that, Tom White, and your example trade.